Well, good morning, everybody. This is Tyler Yell, and it's a pleasure to be with the FX Street Traders today. I am from DailyFX, and it's a pleasure to bring you finding setups like an FX trading desk. This is going to be as interactive as possible of a session in which I'm going to walk you through how some of the top banks in their FX desks build a trading idea and then manage that trading idea. Now, guys, we have 45 minutes, and I'm going to do everything I can to get you really the best information possible and also give you kind of a view at what the key setups are that a lot of banks are looking at today and how that could play out over the summer and the rest of 2014. Now, before we do get started and really hit the information hard, I must go ahead and put up a few risk disclaimers, which is just some simple housekeeping. The first is a risk disclaimer stating that trading foreign exchange on margin does carry a high level of risk and may not be suitable for all investors. The high degree of leverage can work against you as well as for you. Next is a hypothetical performance slide. So we're going to talk about some past setups and how they worked out. Some worked out well, some did not. However, past performance is not indicative of future results. So quite simply, those are the slides that just kind of get everything on right footing. And then here is my contact information after today's session. If you guys want to email me, if you guys want to reach out to me on Twitter or follow me on Twitter, you're absolutely welcome to. So there is my contact information. All right, so we are going to go ahead and hit the ground running. Again, we've got about 45 minutes, so we're going to get everything we can in that time frame. First, let me state off, guys, that I think it's helpful to have a understanding of what we're looking at, right? Because what we're effectively doing is we're saying, okay, those companies that have a key revenue source from trading FX, how do they develop their trading plans, right? How do they view the market? What is different from how they view the market from maybe how you view the market? And so we're going to touch on all of that. Quite simply, there's a key difference, and we're going to talk about this in a little bit more depth in a moment about how retail traders view the market versus how FX trade desks view the market. Of course, that's kind of the gist of what we're looking at today, not only how they view, but how they analyze and look for trade setups. We're going to talk about the preferred technical tools. Guys, it seems like, and I'm sure this doesn't surprise a lot of you, that a lot of the tools out there, let's call it the fancy adjustments to some key indicators are more of a sales tool than a trading tool, right? There's a few that have stood the test of time, and we'll look at those and see how they speak to each other as for a trade idea. Now we're going to talk about what to look for in fundamentals. Now you can see I put in there surprise, and the reason why I put in surprise is because quite simply that's the key thing we want to look for. Is there something that shifts our view from how we currently see things, fundamentally speaking, to how they could be going forward? Right. So we just had some ECB members speak a little bit ago, and we're going to talk about that as we talk about how to read fundamental data, right? And keep that surprise word in your mind because that's key. The next thing we want to take a look at is sentiment tools, right? There's three really key sentiment tools we're going to talk about today, and I'll tell you how to read them, what to look for, and what the most current sentiment tools are showing us today. One just kind of, I guess, giving you the punchline early, if you will. Yen shorts from a reading of the CFTC, the Commitment of Traders report, show that yen shorts are at their lowest point since 2012, before Abenomics even began. So some interesting developments going on with sentiment. Also with FXCM's own sentiment indicator, the speculative sentiment index, we had a key flip on euro dollar last week. So some key things we're going to talk about there as well. And then we're going to talk about how difficult does your strategy need to be. I want to start with this quote from Albert Einstein saying that we cannot solve our problems with the same thinking we used when we created them. The way I define problem from a trading perspective is if you know quite simply that there's more opportunity there's more opportunity out there in the market than you're currently grasping. Well, there's a problem. There's a chasm, if you will. It's something that you need to cross, and that's the problem that we're going to look at creating. All right. So how is an FX trading desk different? Now, this is UBS's trading floor. Many football fields, many soccer fields wide. Now, naturally, there's more here than anyone could hope or ever need. Right. And so quite simply, please understand that's not necessary to trade this market well, right? I've seen guys do very well with just moving averages. So you don't have to have an entire floor of traders and analysts and things of that nature. And in fact, I feel that too much analysis can be a bad thing because it can make you prone to overconfidence in your trading idea, right? Regardless of what the market's going to do, if you're overconfident in one way, it can lead to a quick drain in equity, especially if you apply leverage to that overconfident idea. But quite simply, if you think about it from this point of view, guys, what these desks are doing is they are analyzing every possible type of fundamental data, right? So if these guys are trading the New Zealand dollar, they're looking at tractor sales. They're looking at every aspect of the dairy industry, things that quite simply we chalk up to it's already priced in, right? That's kind of the technical argument, and I'm all for that, right? I'm a huge fan of technicals, but I don't think we can wipe out fundamentals because as things are shifting, which by the way, that I think there are possibly some things shifting in Japan right now. We'll talk about that. Some of the banks have been talking about this recently, that they're instead of looking at supporting growth like they have been since 2012, they're now actually looking at removing stimulus and what could be the effects of that. Of course, these guys have tons of quant models. You guys probably know a quant model as high-frequency trading or program-based trading, right? And so quite simply what they're doing is they are looking for those small inefficiencies to grab in the market. Quite simply, guys, they're looking for pips, fractions of a pips, not quite simply not holding on to a trade for really much longer than a minute, or at the very least, if you're a swing trading fan like I am, most of those quant models are looking for more arbitrage opportunities. And then again, a lot of these desks are focusing on all geographies. Quite simply put, guys, it's more difficult than you and I would ever need to be, right? So just because you see that, don't get discouraged. All right. I also think it's helpful to settle the score, right? Quite simply, banks get stopped out, right? So don't think that they have the golden touch, right? They get stopped out on their trades, and so quite simply, I think the difference between bank traders and trading desks at banks versus a lot of individual traders is they know that each trade, to quote my colleague and friend James Stanley, is but one of a career of thousands of trades, right? They know that no one idea is truly unique and should not set their trading career apart. If it does, chances are they didn't know it before they put on the trade, right? But quite simply, they get stopped out just like you and me. So of course, the key there is managing risks. And then the other thing is to know that they don't know everything. Now, this is actually taken from a few months back. In March, there was this wild spike on Euro USD, and quite simply, the banks were scratching their heads. And this is just a quick blip here from one of the banks that were throwing out different theories, quite simply, as to why we had this spike in Euro USD. There was the fat finger thought. There was the fact that possibly a Euro gold unwind was taking place, and that caused this spike. Maybe it was the Russians. And that was at the height of Ukraine, at the Ukraine land grab. And they're thinking that maybe some Russians were just liquidating a lot of money that was about to be taken. So quite simply, I think it's helpful to know that, guys, they don't know everything either. They know a lot, right? I mean, that UBS trading floor, they're not just sitting there playing on the computer. They know a ton, but they don't know everything. And so this kind of brings it together. But as far as the difference between you guys and the trading desk at these major banks is again that view that each individual opportunity is rather unique, right? They're going to look for imbalances. We're going to talk about how to find those imbalances, but quite simply, they're just looking for an edge and looking to press that edge. What I often see, and I'm not putting this on you guys in the room, but what I've seen being at FXCM, hired in 2007, was at JP Morgan Chase before then, talking to so many investors and traders over the years, they tend to view the market as almost this fairy godmother of sorts, right? Or this tightly wound Swiss watch that is just perfectly precise, right? Well, quite simply, that's not how the banks view the market. And I think it's helpful to get that view out of your mind. That is this Swiss watch that's gonna hit perfectly the 618 Fibonacci level, right? It can move over, and that's why a lot of these banks will look for a close. Or you'll see when a bank puts on a trade and they say what their stop is not going to be just a price. It's often going to be a daily close above or below a certain level, right? And so all that to say, I think it's helpful to know that there's a little bit more chaos than some people give it credit for. Now, this is, to me, a helpful view. This helped my trading a few years back when I at least took on this process. Now, I'm not a fan of random walk theory, as you guys can imagine, right? I'm a fan of technical analysis, meaning that there are edges that develop and that you and I can profit from if we can manage our risk and trade it appropriately. However, what I often see is that most of the banks are not saying, oh, this is ridiculous, the market is way overbought, or this is ridiculous, the market is way oversold. For the most part, a lot of these banks will view the market as efficiently priced, at least to the sort that it's really not worth fighting, right? Because that's nothing that they can stand in front of. Right? If a dam breaks and there is a flood in the streets, it does you no good, excuse me, to jump in front of that water and say, oh, it's come too far, it needs to recede back, right? Just let that water move, let that price move, and what you often see is these banks will say, listen, and in fact, S&P I think is a good example, and you're going to see me guys flipping to some charts every once in a while. So S&P now sitting above 1900. Right. And I think one of the better kind of analysis points that I read was one that looked at the historical runs from 1994. Actually, it was 1987. Excuse me, 1987. After that crash, right, and then that huge pop higher, and then they looked at the 2003 to 2007 move. All that to say, they said, listen, these things have a propensity to move further than most people expect, right? So just because we're sitting right here, guys, I think we could still continue to move higher, right? 1920 looks like it might have some Fibonacci resistance, but outside of that 1920, 1930 zone, a lot of these banks are saying, listen, we're now just kind of looking for 2000, right? Maybe 2100. And so it's that idea that even if it is quote unquote overbought, that doesn't necessarily mean we need to sell it. And so that's what I mean by how they view it as efficiently priced mechanism, right? So this is how we want to take it. And I bring this to you before we actually talk about the tools these banks use, because I think you have to see it in your mind first before you effectively use the tools, that it's best for you and I to study developing imbalances along with text and sentiment, right? So imbalances to me, fundamentals. There's the argument possibly that China is contracting right now. Well, so that's probably going to have a pretty real effect on Australia and New Zealand, given their export dependence on China's demand, right? And so if we can get text and sentiment following up with that, that can be a very, very helpful edge. But again, it's just an edge. So we still want to identify and accept the risk, right? So what is their edge? And that's what we're going to talk about for the majority of this session. And how can you apply it? So this is one of my favorite quotes from Yogi Berra. If you're not familiar with him, I encourage you to become familiar with Yogi Berra. But he said, in theory, there is no difference between theory and practice. In practice, there is. It's so easy when you become a trader to buy a book on trading with Ichimoku, one of my favorites, by the way. Elliott Wave, another one of my favorites. Some type of simple trading system. Right. And in theory, it seems like, oh, this is going to work great. Of course, well, in practice, it's much different because there's the emotion of accepting risk. There's emotion of getting stops out of a trade, even if everything lined up perfectly according to the theory. Right. There's a difference between theory and practice, as you traders all know. So all that to say, it's best to work on quite simply your emotional view of the market. And again, that idea that, listen, for the most part, it's an efficiently priced mechanism, at least to the point that it's not worth fighting against. And so what we're going to do and how we're going to apply the edge, we'll take a fundamental view, right? We'll take a key technical view, and I'll talk about those favorite tools. We'll see if sentiment is giving us an edge. And then, of course, we're going to work to identify and then prevent any behavioral biases that take out many traders, right? And I feel like that's often what gets quanted out from a lot of these banks is trying to program out those mental biases, which quite simply, I think emotions can be one of the more helpful things if you learn how to hone it. There's a great book by Michael Martin called The Inner Voice of Trading, right? It's one I definitely recommend if you're somebody who prefers to read. But all that to say, I think emotions are not the bad thing that a lot of traders make them out to be. All right, so here's kind of the first step. We talk about the fact that a lot of people are prone to buying systems. Well, quite simply, I would say that don't expect to beat these big banks, right? Especially with a system that you get emailed about that shows a 90% win rate over an optimized backtest. Guys, I think skepticism is such a key thing as a trader. And what I mean by that is that anything that shows you a backtest over a fixed period of time and no other time, likely it's been optimized for that period, right? And possibly from whoever's selling the system, not even traded live over that period, just they pushed a backtest across multiple time frames and said, wow, that one performed great, right? I mean, you could have used a 10 and 30 moving average crossover on a weekly chart for dollar yen from 2012 to really early 2014 or May of 2013 and done great, right? But that's just an optimized backtest. Now, of course, we don't want to trade with scared money, right? You'll definitely have what's known as a myopic tendency to only focus on the short term and not look at the big picture, right? And of course, looking at the big picture allows us to focus on the process. And guys, that's something I probably say to myself week in and week out, right? Is this trade a good process, right? I don't care if I think euro dollar is going to 120 or to 150. Is this trade a good process? And I define process by, is there a good edge? And am I limiting my risk so that if this trade goes horribly wrong, and this is what every I think bank does, if this thing goes horribly wrong, then I'm no worse for it, right? Because if you think about it, the difference between a lot of bank traders and you sitting at home trading by yourself is that these bank traders have a desk manager looking over their shoulder saying, if you lose more than 5% of your capital, you're probably not getting a bonus. If you lose more than 10% of your capital you're trading with, don't even bother showing up to work tomorrow, right? Because your key card will not work. So they have this emotional block, if you will, to prevent them from getting into a bad process, right? So that's what's important. So here are the key technical tools we want to talk about. Quite simply, the ones that I see time and time again from bank after bank after bank after bank, Fibonacci levels, right? Looking at expansions, fib retracements all throughout, right? Fibs are highly favored. Even if they seem too mainstream now that they don't provide an edge, they're still highly favored, especially in the context of Elliott wave, which if you're not a huge fan of Elliott wave or if you're not overly familiar with it, it's at least worth knowing the basics, right? That trends will correct often in a three-wave pattern before resuming the prior trend. Simple moving averages. This is something that quite simply a lot of people are surprised about, but they don't use exponential moving averages, right? Because the whole idea of an exponential moving average is that you're putting just a little bit more weighting on that last price, trying to get an edge, trying to get it to turn a little bit sooner. Well, they're not focused on just that, right? They want to see the overall market as it currently is, right? All that to say, simple moving averages give them a context. The most commonly ones I see from bank to bank to bank, and these are the ones I use as well, 21 and 55, of course, those are Fibo numbers, and then 100 and 200. 100 and 200 are just effectively used by fund managers that could care less about text for the most part. So I think that's why 100 and 200 is very important. Naturally, you look at the yen, a very, very important chart that a lot of banks are looking at, right? It is quite simply, we've seen this in October, tested the 200-day moving average 3 times, and now we had a test last week, and we're going to talk about some interesting developments, potentially symmetry there that we'll focus on. All right. Price action and candlestick analysis, they're usually not looking for every tiny pattern that Steve Neeson has found. Usually they're looking for just reversals. That's really the most important one. Walter, you're in luck, my friend. He said, have you already covered sentiment indicators? We have not. So get comfortable, get settled. Hope your coffee's hot, Walter. And we'll be covering sentiment in just a moment, buddy. So again, for the price action candlestick analysis, they're either looking at something like a key reversal, which let me show you one that recently developed and I think could be very, very interesting given its propensity. This is known as a key reversal bar, also known as a bullish key day, right? You can see this firm area of support down here. This is, let me introduce this chart, excuse me. This is the Nikkei 225. So this is Japan's key index. And of course, as you can imagine, there is a very, very high correlation, between the Nikkei 225 and the dollar yen. In fact, guys, I'll just go ahead and throw out this link. It's an article I recently wrote about this. But if I just throw over dollar yen, you can see how incredibly correlated this is, right? So the blue line is dollar yen. All that to say, that's a bullish key week, right? Because these are weekly candles. If it was a daily candle, it'd be a bullish key day. But a bullish key week off of support. So now we got to focus on a push of this trend line. And if this pushes higher, we'll likely see dollar yen push higher as well. Another key week we saw recently, euro dollar, but it was a bearish key week, right? So you can see here we pushed higher than the prior high and then closed below the prior low. So when you have that type of outsized move, that's a bearish key week. Those are usually the price action moves that a lot of these banks are looking for. A lot of the basic price patterns, right? A flag is a simple continuation pattern. A head and shoulders is a reversal pattern. A one that actually just played out really cleanly that a few of the banks have been looking at is, you know what? It's Euro CAD. I don't have that chart, but definitely be willing to pull it up for you guys. Right, so this was a head and shoulders that really could still have some ways to go, right? But again, that's just something that the banks continue to look at are those more simple patterns that show relevancy to the current market. Outside of that, oscillators will help you find a favorable risk to reward, right? So at the very least, you're not buying as oscillators are turning south from 70 or 80 or 90, or you're not selling as oscillators are bouncing off the key low level. One that is near and dear to my heart that a lot of these banks use is what we just showed with dollar yen, which is of course a currency trade, and Nikkei 225, Japan's key equity index. And that is intermarket analysis, looking at correlations from different markets. Right. And then lastly, historical comparisons. And we'll talk about some of those there. Walter said, should we learn Ichimoku Cloud? I have it on MT4, but I've never used it. I heard Ichimoku is a good system if you can learn it. So if I had a space for one more, Walter, I would have used Ichimoku on here because a lot of the banks do use Ichimoku as well. But quite simply, you'll notice that if you're not already familiar with it, it's not too indifferent from moving averages. Right. In fact, it's Ichimoku is about 5 different lines composed of midpoints over different periods. So it's almost like a bunch of moving averages, but naturally 2 of those key lines are filled in, which gives you the cloud. So it's very helpful just to give you a visual representation of, okay, price keeps bouncing off the cloud to the upside. Let me give you I think I had it actually on euro dollar, because the key thing that, if you guys get nothing else on euro dollar, you can see here the daily Ichimoku has recently reversed, right? So we've moved from above the cloud to below the cloud. And the key thing here, this lagging line has reversed. We've also noticed that on euro yen. But one thing I will note, Walter, while we're talking about Ichimoku, is that quite simply, they're usually going to use just daily or weekly Ichimoku. And one of the weekly Ichimokus they're keeping an eye on, as you can imagine, is Aussie dollar, right? Because we've come up to the cloud and we're potentially about to break below. And I have the 200-day moving average on here as well. So if we stay below the cloud and then break below the 200-day moving average, that's a setup that a lot of the banks are looking at. Great question, Walter. Keep those questions coming, please, buddy. All right, so the key components of technicals, right? If you're brand new to trading or if you're not, it's still, it starts with psychology, right? What you're looking for is a shift in psychology. Of course, what I like about technicals is it helps instill discipline, right? If you use Elliott wave, right? It's at least giving you an objective point to say, you know what? I'm objectively wrong. And if I'm objectively wrong, I should get out of the trade, because if I stay in the trade when, as per my analysis, I am wrong, then I'm just sitting on hope, right? It's better, at least in my view, to be objectively wrong than subjectively right, because you can be subjectively right and hold on to a losing trade up into a margin call. So again, what's nice with technicals is when you have these key things identified, and what most traders will do if they have something like a bearish key day or a bearish key week or something of that nature, is they'll use that quite simply. And you guys can see pound is dropping pretty nicely today. So as of now, let's just say as an example, we were to close here. Now we're not, right? Because we still have a lot of hours left in the trading day. We were to close here. This would be a bearish key day, or if you wanted to be a little bit more lenient, you could look at Friday's candle, right? Because this was a holiday in the U.S., Monday's candle. So quite simply, if we get below the low on Friday, that would be a significant development. All right. And what I was going to show you is that if you get a bearish key day, you can put your stop above there. And quite simply, so if you sell off of a bearish key day and put your stop above that day's high, that's a way to say, okay, if it moves above it, objectively, I'm wrong, right? And I should be out of the trade. Of course, early warnings, that can be helpful as well. If you see an exhaustion pattern, I'll often look for those exhaustion patterns to really be a key focal point to draw trend lines off of and really get a gist of, okay, now I'm looking to trade a correction, right? Or now I'm looking for this exhaustion pattern to be overcome to show that the trend is resuming, right? And then also you'll see, and we'll talk about this in a moment, that really no tool should be used in isolation. In fact, here's something that most banks are not going to just say, hey, Elliott Wave shows me this, and I'm just focused on Elliott Wave. That's often not the case. They're often going to stack them on top of each other, right? So it'll be like an intermarket view, along with the price below Ichimoku cloud, along with the move below a key technical level, right? So it's that key view that quite simply we're going for confluence, not only on technicals but other methodologies as well, sentiment, fundamentals, right? Because quite simply it's going to be very hard. It's going to be very hard for these banks to put in a trade when quite simply the techs disagree with the fundamentals. And what I mean by that is that if there's not an overtly sound reason why that's taking place, and what I mean by that quite simply is that if you're looking at techs that show a bearish key day on a dates where rates previously rised, well, then quite simply that could show, listen, you can look at the overnight index swaps, and that's been priced in for the last 3 months. So to get a bearish key day on the date of a rate rise, when that's already been priced in, that can be a reason to fade. But if it's something that quite simply there is increasing monetary policies in favor of the trend, and you get one small bar that goes against the trend, that's not enough. Right, so it's helpful to find confluences which lead to conviction. But again, we always want to be wary about being overconfident. All right, so intermarket analysis. How do you use intermarket analysis? How do you look at it? Well, I showed you Nikkei 225 with dollar yen overlaid. This is actually just a snapshot of Bloomberg Terminal, and what I wanted to show you guys with this is that quite simply, this shows you correlations. To me, the first correlation to always start with is dollar yen. And the reason why is because in my viewpoint and reading bank research, you can see that they're not really going to talk about dollar yen unless they have a clear view of what's happening with 10-year yields. That's the USGG10, if you're not familiar with that. 10-year yields, the S&P, and the Nikkei as well. And you can see here, this is a correlation coefficient. If you guys aren't familiar with correlation coefficients, it rates from +1 to -1. So +1, you can see there, dollar yen is positively correlated to 1 of dollar yen. So it's naturally a perfect correlation. But anything above 50, 0.5 is usually considered a rather significant correlation. You can see here the Nikkei 225, the SPX, the dollar index, stocks, all very highly correlated. So that's usually what they'll look for. If there's a highly correlated market or an inversely correlated market, naturally you can see here, dollar Swiss, heavy inverse correlation, dollar Swiss to euro USD. In fact, it's if you like shorting, right? But you're not sure what to do with dollar Swiss, you could effectively go short euro dollar, right? Because they're almost the same thing. It's not a trade recommendation, but quite simply, that inverse correlation is so strong, it's worth noting. Now, another thing a lot of banks would like to look at is quite simply historical relevances. And so with historical relevances, this is one that one bank put together, just showing this common pattern of dollar weakness and dollar strength, dollar corrections, right? So going back to the 80s, they show that there was 7 down years to the dollar, effectively a 3-year correction, and then a 5-year bull market. 2002, right? We topped in the dollar in 2002, had this 7-year downtrend, and then this kind of sideways move for 3 years, and now they're looking at potential for another really strong push higher. This is just another way to look at it, right? So quite simply, you see strong move down, lull, and then break higher in 2002, strong move down, lull, potentially another break higher. And let me show you guys the dollar index, because this is going to be a pretty interesting chart for us to keep an eye on. This is the dollar index. If you guys aren't overly familiar with the dollar index, it's FXCM Dow Jones Dollar Index. And what's unique about it is the DXY, which is this chart I just had up. It's almost euro dollar. It's a 57.6% weighting of euro USD, about 14% dollar yen, about 10% pound dollar or cable, and then a few other smaller denominations. The FXCM Dow Jones Dollar Index is a equal weighting basket of euro dollar, cable, dollar yen, Aussie dollar. Right, so it's just giving you a little bit more balanced view. And the key level we've been watching here from the FXCM Dow Jones Dollar Index is this 10.5 level, right? Because quite simply, you can see here, this is the kind of the opening range high, if you will, for the year of 2014 in January. This is the July high. And so quite simply, what you're noticing here, and this takes the most recent trough, if we've bounced again, guys, off of that 10.350 level. It's also the 50% of that overall move higher. So take that off there. So quite simply, we had a key technical level break, and this is something that a lot of the banks have been licking their chops on, right? Dollar strength. When will dollar strength resume? Because you can build a whole portfolio on dollar strength. And quite simply, we're seeing different tactical things starting to develop to show that view. Earlier, I mentioned how FXCM sentiment tool, the SSI, the Speculative Sentiment Index, just had a key shift on euro dollar. And so it's things like that these banks are looking at by simply saying, okay, listen, the dollar's been beat up since July. Is there going to be any respite? Well, this is some interesting just kind of correlations, right? I talked about how the fact that a lot of these banks will look for similarities. That's right. So 7 years down, sideways market for a handful of years, and then a strong push up. Well, here are some more, quite simply, just using some Fibonacci relationships of time, some more recent developments. So if you take this impulse here, the correction the correction equaled itself, right? So you can see down here this red candle. So if I go low to high, you can see it's 100% in time there. So an equality of time of this impulse versus this relationship. And now we're breaking higher. Definitely one to keep an eye on, right? Because quite simply, you can see there that downward move, at least from a price perspective, you can see the 50% retracement right there, ran out of steam, and we're now pushing higher. And then you can see from a time perspective, we're effectively running out of steam to the downside, similar to like we ran out of steam on the upside here. Another interesting time relationship that's worth keeping an eye on. If you look at this correction, right? So this was seen, if you're familiar with Elliott Wave, this was seen as a triangle 4 on dollar yen. Quite a few of the banks have this count on dollar yen from an Elliott Wave point of view. If I take this here, you'll notice that from the top to the bottom there, and you'll notice this candle that we bottomed out recently on was almost the equivalent, or it was the equivalent, excuse me, of this correction. So we'll look for a move into 102, possibly higher. Remember, we just showed that bearish or bullish key week, excuse me, on the Nikkei 225, which could post higher prices there. So that's just some interesting corrections that we've seen in both the dollar index and the dollar yen, could potentially pointing to higher prices. All right, we've got about 10 minutes left, so I'm going to run over this quote. The fundamental tools, naturally, what we're looking for are what are the drivers of monetary policy, right? The kind of rule of thumb is that any currency has 6 key data points, and quite simply what they'll do is these banks will look for surprises, right? So this is something that quite simply Citi created, and got to give credit where credit's due. It's a great tool, but to me, what's great is how simple it is. They aggregate out how economists are expecting a newsprint, and they start to look for a pattern of negative surprises or positive surprises. Of course, positive surprises are bullish, negative surprises bearish, and you can see here that, and this is an old reading, I'll give you guys a more updated reading, but as of today, Norway and Aussie have the two strongest positive surprises. It's interesting that Norway has the strongest because, quite simply, Sweden and China are on the bottom. So that's quite simply been breeding the view that China is potentially contracting, not just slowing down, but contracting. And so here's just kind of some questions these banks will ask themselves. Now this tool is quanted out by Citi, but you don't have to reinvent the wheel, right? You can just look for, are there shocks, and if so, where? And are these on key data points, right? Of course, another fundamental thing these banks are going to look at, the central bank calendar, right? Because it's important to have those data points like GDP, inflation numbers, employment. But what are the banks saying? And this morning, guys, ECB's Nowotny said that there was a discussion about lowering rates at the next meeting. He said inflation is so low that it slows down economic growth. And so all that to say, things like that absolutely catch the sight of these bank desks and help them develop their views. And you can see, if I'll go back to that euro dollar chart, where we're trading on the day with euro USD. Right, so kind of an exhaustion weight to the top side and looking for another push down. Now, this is the opening range low, so we'll continue to keep an eye on 3612. But what I wanted to show you guys, I'm actually going to use a longer term cloud. You can see there's a ton of confluence down below, right? So this is a weekly cloud. This is the 2014 low. This is a level that a lot of banks are looking at on euro dollar, right? Because now that we've broken here, the view is that there's potentially a double top and we could be moving lower. So that's a key one to keep an eye on. But absolutely, the central bank calendar, very, very important to keep an eye on. And again, with that, the central bank calendar is going to show you who's speaking, what they're saying, and how you can build up a view. All right. So here's another slide I'm just going to go across quite simply. The gist of this is that trading without fundies is often a riskier view. When the fundies confirm the text, that's the ideal scenario that you want to be looking at. Jesse Livermore called that underlying conditions. All right. Now we're getting on to sentiment. So quite simply, there's three kind of key sentiment tools that are often used. One is particular to FXCM. We'll talk about that in just a moment. One is the Commitment of Traders report from the CFTC. To me, what's interesting is that you can see there, yen net speculative shorts have dropped to their lowest level since pre-Abenomics, right, since 2012. So what that's showing us is that quite simply the major funds have kind of gotten out of their yen shorts trades, right? So the major desks, the major shorts are getting out of their dollar yen short, euro yen short, things of that nature. So it'll be interesting to see how that develops because there's been a major shift, as we can see a 2012 low on yen shorts. So very interesting there. Another thing that a lot of banks will look at is quite simply flow, right? Because what they want to see is what are different sectors of clients doing. My favorite to look at are what's known as real money clients, right? And this you need specific bank information on, right? Because quite simply, there is no centralized exchange in FX, right? And so these large banks, these prime dealers are about the closest thing there is to an exchange. And so when you can look at real money players or speculative players, that can kind of give you a feel. Now, if you want to get the cleanest feel, I think, of what the speculative crowd is doing in the currency market, I think the Speculative Sentiment Index is a great tool. So let me just go over to that real quick. This is the slide on bank flow. So this is an update on SSI. Now, let me ask you guys can just type in the chat question form. Are you familiar with SSI? Speculative Sentiment Index. At DailyFX, guys, we call this our secret sauce, and it's available to all FXCM clients. Of course, if you have a broker you're trading with now and you're not ready to switch to FXCM, you can be a subscriber to DailyFX Plus, which we give 2 updates a day. But quite simply, what I wanted to show you guys with this is that we had quantified out effectively this out overlay, right? That shows you how our FXCM book of retail clients are sitting versus price. And what's interesting, and you see this time and time again, is that retail traders will often fade strong trends. They'll often try and Sell what they believe to the top, sell what they believe to be the top, buy what they believe to be the bottom, right? So what's interesting about this is time and time again, you'll see this play out in which clients unfortunately pick the top of the market, but not the way that they want to, right? And in fact, dollar yen is a preferred example of mine in the sense that on May 23rd, 2013, on dollar yen, right here, the FXE client base, which is over about 200,000 live accounts, flipped from net short to net positive. Right now, of course, a lot of clients probably made money on this move higher, but that's just showing overall positioning. And what we just saw last Friday was that for the first time since this move down here in July 2013, euro dollar SSI flipped from net short to net positive. Right, so it wasn't until really this move down here that clients went net positive. So that's a contrarian indicator based on common activity we've seen from clients, right? From retail clients, which is again, fading strength, right? Trying to sell what they believe to be the top, which definitely might not be, right? Because they were net short throughout this entire move from 127.50 to 139.92, right? So if you're not familiar with SSI, it's something I definitely recommend you get familiar with. All right, guys, so just a few more slides left. This last one just says quite simply how difficult does your strategy need to be. Guys, make it a repeatable process and do everything you can, I feel, to eliminate harmful biases, right? Some of the more harmful ones, confirmatory bias, right? That's where you effectively have the mindset of show me what I want to know, right? Show me what I want to see. Overconfidence bias, right? Where you feel that if I hit a profit on this trade, it was skill. If I got stopped out, it's just bad luck, right? You want to be humble with the market, right? I often say check your ego at the door when you're trading, and then quite simply know that it doesn't pay to beat or outsmart the market, right? That's the view that a lot of the banks have, right? They'll get stopped out and they'll say, well, that's okay. All right, so we talked about mental biases. Guys, let me just leave you with some of the developing setups a lot of these banks are focusing on, and then we'll open it up for any questions if we have time. But again, I just talked about the speculative sentiment index, and there's been a big turn there, right? We've just broke through some key support levels on Euro USD. And so the question that a lot of these banks are looking at, and to be fair, it's a question they've been asking themselves for all of 2014, is has euro dollar turned? Will euro dollar turn, right? Because really since October, since this high we hit in October, we've just kind of been oscillating around it. And now we're starting to see some push to the downside. Again, this is a weekly Ichimoku cloud. If I go back to a daily, you can see that we're starting to see signs of reversals. Right, so that's a key one to look at. And then if we do get that further move down, that 34.75, 34.30 is a key level we're looking at. Other key things, what's going on with dollar yen, right? Because quite simply, I think the path of least resistance, looking at other markets like 10-year yields, the Nikkei 225, other yen crosses, it looks like we're about to continue higher. S&P, right? S&P's above 1900. The path of least resistance is to the upside. Right. And in fact, when a lot of people were asking me, I have a trading program that I'm a part of called DailyFX on Demand, and I'll send you guys the link in just a moment. But a lot of people said, what's going to be your entry on dollar yen? And in no uncertain terms, it was below the 2014 low, right? Because that's below the 200-day moving average. Effectively, there's a lot of support that has to break through here. So we'll continue to keep an eye on it. But in the near term, guys, I think the path of least resistance is to the upside. And don't forget that correlation of 99 days from top to correction bottom, 99 days from top to 200-day test, and then rejection to the upside. There might be something to that. Another key thing that a lot of guys are looking at is, has the dollar index really turned? If the dollar index has really turned, what does that mean for gold? Guys, this is a pattern I've been looking at on gold, and banks have as well, that quite simply this flat correction, so to speak, might have played itself out, right? And so quite simply what we're looking at is, do we have a strong move to the downside ahead? You get a daily close below this level, that's going to be very significant, and something that a lot of banks are focusing on. So again, the dollar has bottomed and starts to move higher. That likely means, and I'll just show you guys another overlay here if you haven't seen one, that likely means a pretty bleak future for gold bulls, as it historically has. You can see here, I'm going to go to a weekly chart. You can see it's not a coincidence that in 2011, when the dollar bottomed, is when gold topped, right? So it's important to keep an eye on that. And then lastly, does Aussie dollar still have room to decline, right? A lot of banks think it has significant room to decline. And so quite simply, that's something that I think most of you guys should just keep an eye on, because if we stay below this 94 zone, right, and then more importantly, break below the 200-day moving average, we could see a pretty significant test to the downside. All right, guys, and so we are running out of time. Let me just take a few minutes to introduce to you. This is our trading program called DailyFX On Demand. Now, you absolutely do not have to do this, right? This is something that is a premium subscription service for those of you who are fans of DailyFX analysis. We do offer real-time speculative sentiment index, so we'll look for intraday shifts. Of course, we'll have access to the Bloomberg terminal, and we'll be looking up bank research. We have access to a lot of the key trading desk notes of some of these large banks. And so throughout the day, we'll be reading those out. All right, so we'll be reading bank flow. We'll be reading bank research that talks about certain edges that are developing, right? Like, so here's just one example for what it's worth of a bank that's looking at a bunch of similarities, quite simply, with crosses very correlated to dollar yen. This came out this morning, right? And they're effectively saying, okay, this is showing us that the highest propensity is for a push higher in dollar yen. But quite simply, so we just look at different pieces of research to find edges, right? We trade ourselves in the program. We'll talk to you about our own trading. And so it's a helpful program if really you're already kind of comfortable with the basics. We don't teach in this program. The purpose of this program, quite simply, is to show you somebody who hopefully already has a good understanding of how the market works. And I'll go ahead and just throw the link down in there, guys. But it's to show you, quite simply, what the banks are looking at, how the banks are trading it. We'll show you bank portfolios and things of that nature as well, because that can often be helpful to say, okay, well, I want to see where the banks, if they've put their money where their mouth is, right? So here's just an example of a current portfolio update we got from one bank this morning. You can see it's effectively dollar yen, euro dollar, dollar Swiss, some of those key dollar plays. And again, it goes to that question of, has the dollar turned? So again, that's DailyFX On Demand. I just sent you guys the link. I hope you got it. It is a subscription service, and we are working on the second generation of DailyFX On Demand, which quite simply will give you your own site, which will be updating bank research constantly. Because right now it's just verbal access to the bank research. We're reading it out. We're posting it on the screen, for you to take snapshots and things of that nature. And we're also, of course, we do the correlations every day. We got a question earlier how to get those correlation numbers. We get those from the terminal, the Bloomberg terminal. We share those daily on DailyFX On Demand. There's some other places to get it as well. So quite simply, I'm not sure. DailyFX, of course, has them as well, updated about once a week, but we try and run those every day to see if there are any edges developing in the here and now. All right, guys, and then to end the presentation today, I'll go ahead and lead you one more time with my contact information. I know some of you were not able to make it in as the presentation started. So I want to thank all of you guys very, very much for your time today. And that's actually going to bring us to an end. So this will not be my last presentation with FX Street. I promise you, if they're kind enough to have me back. So I look forward to being with you guys again and actually talking about those edges that are developing, as opposed to just how the banks look for those edges. So guys, I wish you an excellent rest of the week. Happy trading and stay nimble. We'll talk to you guys soon. Have a great day.